Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis, to Taking Stock, episode number 13.
Lucky number 13.
Well, it is for me. That's my number, you know.
Is it? There you go.
13.
Yeah.
So I was good. You know, I did think about calling this episode 14 because, you know, you've been to those hotels where there's the 12th floor and then the 14th floor. Mm-hmm. So I didn't know if we were going to have the 12th episode and then the 14th. I guess 13 doesn't bother you.
Not at all. I would actually ask to stay on the 13th floor.
Well, good. Well, all you got to do is say, can I stay on 14? Because that is...
Well, yeah, good point. Yeah, right. Exactly.
It is Tuesday, November the 21st, as we sit and record this 13th episode of Taking Stock. So we are, as you just said a moment ago before we went on live here, 2 days away from Thanksgiving.
Yep. A lot to be thankful for.
That's what we want to talk about, is if we're talking about the world of finance and the world of economy and the world of investments, you know, and we'll just go from Thanksgiving a year ago to Thanksgiving in 2 days. There's a great deal to be thankful for.
Yeah, very much so.
Or proper grammatical English for which to be thankful.
That's why you're the interviewer.
Making a statement. Well, yeah. You just said we have a lot to be thankful for. Yeah. What are some of the things that come to mind for you immediately? I mean, you know, in the business that you're in the investment business, in tracking the economy and tracking the money markets and everything, what are the things that that you want to tell everybody that we can be thankful for?
Yeah, well, I mean, number one, I think there's always a lot of things to be thankful for. Okay, I'm kind of that guy. There's always, be happy where you are, be happy with that day and all those things. But this is an investment show, so we'll talk investments. So, I mean, things have changed drastically from last year. If you look at the performance of our indexes. The S&P 500, toward the end of year last year, we were down 20%. International stocks were down 20%. Bonds were down 18% because we were raising rates, through the roof during 2022. So there really wasn't a great place to hide. So now compare that to this year. The stock market's up. It's been doing a lot of bouncing around, but I think as of today, we're up about 15%. So that's good. Bonds, if you want to look at it this way, you can go get a money market fund for 5.25%. You can get bonds for a corporate bond or something like that. 6% on the short end, and so the nice thing about that, especially if you're me, is I'm thankful because now we have reasonable alternatives for the portfolios. So
I want to back up for just 1 second. We'll continue on the thankful, but you talked about I like to make sure I understand, and maybe it helps some of those who listen. So 6% corporate bonds, 6% on the short end. Mm-hmm. Short end means
so you guys short. You can buy bonds that are 3 months until maturity. You can buy bonds that are 30 years until maturity. So when you talk about the yield curve, I'm looking at the shorter end, the 3 months, the 6 months, the 9 months, the 1 year, a 1 to 3 year, a 3 to 5 year, but the shorter end of the maturity range is what I'm talking about. So
how does that compare? Like if you're talking, we're around 6% for the 3 months, 6 months, whatever. Right. How does that compare if somebody actually buy, let's just say a 5 year? Mm-hmm. What kind of number would they be at
today? Yeah, if they bought it today. I mean, you're looking at so on the Treasury you're looking at about 5.5%, right around there.
Okay.
But then you're going to take, if you're buying a corporate, you're taking a little bit more risk. So yeah, you're banging up against that 6% range. So if I don't like stocks, now I have a reasonable alternative, right? I say,
Right.
well, I can go buy bonds or I can go get a money market at 5.25%, but I can buy something, move in something, and I can maybe ladder a bond portfolio, which means buying different maturities. So,
Right.
but I can do that, and with relative lower risk, compared to the stock market. I can do something. I can protect my clients, and I can still make them some money. Whereas a year or two ago, the alternative was I could be in stocks or I could be in something that was yielding 0.5%.
Right.
That's how much we've raised rates here in the last let's just call it 2 years. Yeah. And so I mean that's a nice thing from a portfolio management standpoint. So. The other thing is you look at last year we had we had unemployment that was much higher. We're now at 3.1% or 3.2% on unemployment. So the unemployment picture is much better. Look at inflation. I mean that's right smack dab in front of all of us. But a year ago, I think in November, you pointed out it was like we're at 7.1%, and now we're at 3 or 3.2%. So inflation is much better. So that's something to be thankful for. Now, again, the pessimist in me or the cynic in me is still, we still had that 10% inflation. We still had that 7% inflation. Well, just, that's great that we're not going up as fast as we were, but we're still going up on top of those numbers. So,
well, a common theme for us on that same note, not going up as fast, still going up, but a common theme that we've talked about on Taking Stock, especially the last couple episodes, and I'm touching on it again today, is, the gains versus, like you said, the stock market's up like 15% right now.
Yeah.
Well, but the gains, don't match that, but because we're recovering some losses.
Oh, most definitely. Yeah,
So,
if you lost 20% last year, you make back 15% this year, you're still down.
Right.
Yeah, so.
Well, but the good news is, and Chuck learning as we go and trying to do some numbers himself, and I said, we were talking about what the S&P earnings for, up to date over the last 12 months is 1.8%.
Yeah.
That's what they're reporting right now. Yeah. And about 2% on the Dow Jones, which, it is what it is. Yeah. But that does reiterate or confirm, the conversations we've had here on Taking Stock, talking about, hey, it's good to see the trend upward, the 15% increase on the market right now, but that has, what do you want to say, translated only to at least earnings, though. That's what I'm getting at right now, is since we're sitting here Thanksgiving week and trying to be grateful and thankful for that which we do have, and in this business, in the world of investment and the world economy, the U.S. economy, and money markets and everything else, at least it's a 1.8% gain.
Yeah, and you make a good point, because 1 year ago or so, Fed Chairman Powell was saying he was expecting the gross domestic product or our economy to grow hopefully at 0.1%. Well, guess what? We're growing at 2.9% this year. So, yeah, I think the positive is that we've had very negative rhetoric for the last 2 years, and that 1.8% comes from that rhetoric because people kind of tighten up a little bit, but also we've raised rates, whatever it is, 5.5%. So that every time you raise rates, you're tapping on the brake. And that's what's happened. We slowed down, but we're still getting good. The numbers are coming in better. Corporate earnings numbers are coming in better than expected, much better than expected anyway. And the other thing to remember is when we invest, we're always investing for the next 6, 12, 18 months going forward, right? So that 1.8 is a true number, and I'm with you. I'm glad it's a positive number. But I'm looking 6, 12, 18 months out where I'm hoping that it's much better. And that negative rhetoric, honestly, I think I've made the point on the show here, but I know I say it ad nauseum to people, that the economic numbers don't match up with the rhetoric. And that's kind of what we're seeing. If we're looking at something positive, that things are much more positive now, because I think that negative rhetoric is kind of starting to move behind us, and people are getting more positive. So, I mean,
well, it's interesting because Art, when you bring up, as you said, ad nauseum, the fact that the negative rhetoric, and to what do we attribute that? Is it politics? And it's my side versus your side. So the negative rhetoric is being spewed out, though, in a political battle, as opposed to somebody's reporting truth about what's really happening.
Yeah, from a political standpoint, yes. I mean, the fact, again, it's fear and greed, right?
Yeah.
So I think the lack of our political leaders able to work together, I think that creates some fear. You oust your Speaker of the House. That is not a positive, and that will generate some fear. I mean, in the House, while they're looking for, and then they found one. While they were looking for one, there was no House business being done. Right? Well, that's not a good thing. So that generates a little fear. Then you have, you have Israel, and you have Ukraine, and those things. But I think the bigger thing is, and the biggest chunk of the fear that was being generated was coming from the Federal Reserve. Every single month, Fed Chairman Jerome Powell was saying, I want 2% inflation, and we're at 3%, so he still wants to get to 2%. And he says it month after month, and almost, it doesn't, we might push the economy into a recession. It doesn't matter. The goal is 2% inflation, and the economy might have to suffer. He said that month after month after month, so everyone's looking for a recession. Well, there was supposed to be a recession in 2023. Didn't happen. Doesn't look like there's going to be one in 2024 unless something really bad happens. So now we're looking at maybe 2025. It's just not there. The numbers aren't there every single month, and we talk about this as it might not be exactly the number we wanted, but it's a better number than the month before. And then the next month, it's a better number than the month before. Things have been improving for a very long time, and I just think it's a good thing. People are actually starting to come to a realization that maybe things aren't as bad as they were being portrayed.
Yeah. Well, and you brought me to, we did an interesting little piece from 2 weeks ago with episode number 12, but in between, about a week ago, we talked about a couple of good things that happened. They got the speaker, they got the budget passed, and so the money's flowing to pay, not shut down the federal government, and so that fear factor disappeared with getting somebody in there and getting that budget passed. So we did a nice little update a week ago. But the other side part of that I mentioned to you when we talked about it was now the idea was that there's not going to be another interest rate increase this during 2023. Of course, we're less than 60 days. We're 40 days away from the end of 2023 anyway.
Sure.
But that's a good piece of news.
No, it is a good piece of news. And yes, 100%, that's a good piece of news.
Yeah.
But yet you still have the Fed chairman out there going, well, we're still going to do whatever it takes to get this to 2% inflation, right? And that doesn't mean that we're not going to start raising rates again in 2024. So that's the rhetoric. Right?
Well, don't start up the fear factor again.
I spend a lot of my life looking at these numbers, right? The average person doesn't look at these numbers, right? They don't. That's not in their bailiwick, right?
In the time that we're together every 2 weeks, I can tell the people listening, you look at the numbers more in the time we're together than I look at in the course of a year, typically.
Sure.
So you're looking.
I'm also getting paid to do that. So
not by me.
That's a good thing. At least I'm getting paid to do it.
I hear you. Yeah.
No, but so if you're the average person, you're not paying attention to all these monthly numbers and everything unless they come on the radio and say, hey, they were looking for 200,000 jobs and they only got 150,000. Well, okay, but you keep hearing we're going to go into a recession, we're going to keep raising interest rates and things like that. That just generates fear. And why, if I'm an investor, why would I go invest in something if I'm being told that the future is not as rosy as Art Jarvis keeps saying it is? But this year's been rough. I mean, it's been better. Thankful for that, but it's been rough. I mean, we have seen a lot of volatility, and of course, my thing, I should get a T-shirt or something. But with volatility comes opportunity. With chaos comes opportunity, and that we've seen that here in the last few weeks.
Right.
We basically, in the last, let's just call it 5 weeks, we gave up all of our gains for 2023. We dropped down to whatever that was for. Let's just call it 4,300, 42 something.
Right.
And here within the last 2 weeks or so, we've raced all the way back up. We're almost up to, we're at 45.50, somewhere right in there right now on the S&P. Sorry.
Right.
We're heading towards 4,600, and we've gotten it all back. So we lost it all and gained it all back within a period of like 5 weeks. We've had 1 week was up 6%. There was a Friday we were up 2%. There was a Monday we were up 1.5%. The market doesn't do that, right? We're all over the place, and that's just because of so much uncertainty.
Yeah, your word that has stuck with me is that ridiculousness.
That's right.
Which, of course, got you a little hot under the collar. I can still tell that there's just a little bit of heat under that Art Jarvis collar over the stupid thing with the speaker issue.
Yeah.
Getting rid of the speaker and creating that time of fear for a ridiculous reason, and therefore the ridiculousness. So that's the word. The last few weeks, I keep, every time I think Art Jarvis, I keep thinking he threw out that
ridiculousness.
This ridiculousness.
It was. We're in a spot where we're trying to get things to be better, right? And in a lot of ways, not just investments,
sure.
but a lot of ways. You want better, you want to see better, and then this whole thing with tossing the speaker of the house, just to me was god awful. Not only did you throw out the speaker of the house, but you did it without a plan afterwards.
Well, no, you know what? That is an excellent point. There didn't seem to be a plan. It was just toss and burn.
That's right. We'll figure it out afterwards.
It didn't work very well.
So, when I'm looking at it from the standpoint, I'm looking for confidence. I'm looking for something. I'm looking for a good foundation. I'm looking for something to be solid. That's just I'm looking at it with some hope. It's like, okay, just slash that, right? It's just I don't understand that they have to do better. Our leaders have to do better. So, yeah, you're right. I get a little hot under the collar about a few things, but that's one of them.
Well, we're coming up pretty fast on closing out episode number 13, but I did want to touch. So the elections are behind us, because 2 weeks ago it was election day. We didn't know what the outcome was going to be. We talked about the fact that ultimately, in the long run, it really has very little impact on what happens. And so here we are, 2 weeks after election day. Things are just as chaotic or just as settled as they were before, yes?
Status quo, whether you like it or not. Whether you like status quo or not. Yeah, you're right. It's still chaotic. And it's not going to, let's be clear, it's not going to change anytime soon.
Yeah.
So that's why I think it's more important for me in my work, and it's more important for people. You got to take a long-term view on things. You got to look at the numbers. If you listen to the rhetoric, the world's coming to an end. If you got to watch the numbers, you got to watch the trends. Because if you don't do that, you get whipsawed all around, and you're forced to make decisions that you should not make, and you end up worse off because of it.
Right. So again, as we near the end of the episode today, I want to go back because we talked about it's Thanksgiving, and we have a lot for which to be thankful.
Very much so.
So recapping, like 1, 2, 3. What are the three things that you went through at the beginning of this episode? So 1, 2, 3. What are we looking at that are the real strong positives to be thankful for?
Yeah, everyone likes the fact that their 401k goes up. So positive markets.
Yeah.
3.1% unemployment. So. A good chunk of people are employed, and at 3.1, supposedly that's the vast majority of people who want to be employed. are employed.
Right.
Number 3. What's number 3?
Well, the inflation rate.
Yeah, I mean, yeah, inflation. Yeah,
say.
it's good. Inflation is, and yeah, I mean, I'd much rather have 3.1% inflation, 3.2 inflation than 9% inflation. Let's be
Right.
clear about that. So, yeah, I mean, if you want to make that number 3, but I just, if you just go based on your gut, it just this year feels better. It feels way better than last year. Last year did not feel good at all.
So when the Jarvis family sits down, and thank you for the update and the positive outlook, because from Thanksgiving 1 year ago to Thanksgiving 2023, you pointed out a lot of positives and things, at the end of the day, trending in the right direction.
That's right.
And so it's getting, if we want things to get better, and what 2023 showed us is things are getting better.
Mm-hmm.
So whether they're where we want them or not, or whether whoever wants them or not.
Right.
But anyway, Thanksgiving Day's Thursday. So first of all, from Chuck Gibson and Loveland Beacon, happy Thanksgiving to everyone out there.
Yeah.
And to you, Art Jarvis, and to your family, happy
Thank you.
Thanksgiving.
Happy Thanksgiving. Appreciate you. Appreciate this time, and hope everyone has a wonderful Thanksgiving and a wonderful holiday season.
Well, so then the last question, though, as we close it out is, so when the Jarvis family sits down to that Thanksgiving feast, this is the opening for you, as opposed to the money and everything that you do for business every day. What are you going to be thankful for?
Oh, I'm always thankful for my family. Yeah. You always have family. Yeah. God is good. God has treated me and has blessed me way far beyond what I probably deserve. So, thankful for the community we live in, and just I got nothing to complain about. Let's put it that way.
Very good. So, well, likewise, when we sit down on Thanksgiving Day with our families, that's, here we are with our family. That's a good thing.
In the end, that's what it's all about.
Amen.
There
Well, listen, and I'm going to be thankful for Art Jarvis and taking stock, so thanks again.
Yeah, thank you. Appreciate you.
You bet.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.